Welcome to Capital Allocation Lab Calm. Clear lessons that turn classic investing ideas into practical decisions for owners and long-term investors.
If you value fundamentals over forecasts, you're definitely in the right place. Please subscribe and leave a like so more thoughtful investors can find these deep dives. It really helps us keep the content free and high quality.
Today, we are really digging into the playbook for, well, the more active investor. We're unpacking a classic text, something absolutely crucial for anyone serious about maybe improving their returns through diligent work.
That's right. We're talking about Benjamin Graham's Chapter 7, Portfolio Policy for the Enterprising Investor, the positive side.
Yeah, this is such a critical point in Graham's whole philosophy.
Yeah.
The defensive investor, they focus on discipline, quality.
Right, safety first. But the enterprising investor, they're actively looking for something more for that alpha.
So our mission today is really to take this sort of timeless field manual and translate it. Make a clear, actionable routine you can use in today's market.
And the focus, crucially, is on selection, price, and how you structure the portfolio. That's where the edge is. It's not about predicting the next big thing, the next rate hike or whatever.
Okay, so let's start right there. Who exactly is this enterprising investor? It's important to define.
Definitely. And it's not someone just gambling or chasing hot tips, no. Graham defines it as someone who commits to devoting significant real-time and intellectual attention.
Real effort.
Real effort to their portfolio, all aimed at seeking returns that are better than average.
But it's earned, right? Not just hoped for.
Exactly. It's an earned expectation. That better than average return has to be based on that effort, on refined judgment, and importantly, on a robust process.
So digging into research, valuing companies carefully.
Yes, and being willing to commit to assets that maybe others don't like right now, maybe they're misunderstood. But, and this is absolutely critical, Graham insists they have to strictly avoid speculation, no forecasting future events as the basis for buying.
And that effort requirement, that's probably the biggest hurdle for most people, isn't it?
I think so. I mean, the defensive investor, they buy quality, they hold. Time does the work. Compounding is powerful.
Right.
But the enterprising investor, they accept, they might be wrong sometimes, they accept the cost of time, the hours spent reading reports, normalizing earnings, building those valuations.
That sustained effort, that's the price you pay for expecting that extra return.
That's the deal. So the core contrast is key. Defensive investor prioritizes quality and policy. Always. The enterprising investor, once that foundation is there, earns the right to expect more through that careful, focused work.
Okay, so Graham breaks down this extra effort into 4 main buckets of activity. We've updated them just slightly for today's world.
Yeah, the first one, and he issues a big warning here, is buying in low markets and selling in high markets.
Market timing. The siren song.
Precisely. Graham knew it, we know it, consistently timing the market. It's incredibly rare, almost impossible long term. So this activity is really more about having the discipline to shift your allocation based on valuation levels, not just gut feelings.
Got it. Okay, what's number 2?
Second is buying carefully chosen growth stocks. Now, you can't ignore growth. Compounding is just too powerful.
Right, it drives everything.
But to do it the enterprising way requires really sober expectations and just unwavering valuation discipline. We'll definitely dig into that more.
Okay, and the third, this feels very Graham.
Oh, absolutely. This is maybe where his work shines brightest. Buying bargain issues.
Deep value stuff.
Exactly. The classic net current asset value stocks, NCVs, companies trading below book value sometimes, or just stocks selling below a really conservative estimate of their intrinsic value based on, normalized earnings power.
And the last bucket.
The fourth is buying special situations. These are more event-driven. Think mergers, liquidations, spin-offs, maybe complex restructurings.
So the return isn't tied to the overall market direction?
Not primarily, no. It depends on a specific event path playing out and the probabilities around that event. Very different game.
Okay, 4 buckets. But before we explore those in more detail, you mentioned something fundamental Graham's core belief.
Yes. Process beats prediction, always. Your policy, the rules you set beforehand, that's your ultimate protection.
Why is that so crucial?
Well, think about buy low, sell high. Sounds simple, right? But turning it into a formula that works consistently, almost impossible.
Because markets can stay irrational.
For a long time. Longer than you can stay solvent or just patient. Prices can stay low even when the value seems obvious, or stay high when things look shaky.
So instead of predicting, you set a policy, a system.
Exactly. A definitive mechanical policy. Grand's baseline suggestion often was a 50-50 stock-bond mix, but with flexibility.
Like a corridor.
Precisely. Maybe you let stocks drift down to 25% of the portfolio or up to 75%, depending on how the market is valued.
And the genius there is that the market's extremes trigger your action, not your own forecast.
Yes. You're letting price dictate your process. Think how hard that is behaviorally, though.
Oh, definitely. Market's euphoric. Everything's expensive.
And the policy forces you towards that 25% stock allocation. You're selling into strength, which feels wrong.
And when there's panic, blood in the streets, prices are dirt cheap.
The policy forces you to lean in towards 75% stocks, buying when everyone else is selling. That takes real discipline.
So that's the core idea. Set the policy, the guardrails. Then let the price come to your process. Your nudge isn't being a hero. It's selection and structure sticking to the plan.
That's the enterprising way, according to Graham.
Okay, let's dive deeper into that second bucket then. Growth stocks. They're always tempting.
Always. Because high compounding, well, that's how real wealth gets built. Graham's definition is simple enough. A stock expected to grow earnings faster than the average company over time.
But he was cautious, right? You mentioned cautions.
Extremely cautious. Because chasing growth blindly has led to so many disasters. He points out two big risks, really interconnected risks, that the enterprising investor has to manage.
What's the first one?
Expectation risk. Think about a stock trading at, say, 50 times earnings. That price already assumes years and years of fast, uninterrupted growth.
It's priced for perfection.
Exactly. But that growth curve will flatten eventually, or at least slow down. It always does. So the real question for you, the disciplined investor, is how much of that future perfection is already baked into today's price?
Because if there's even a tiny disappointment,
boom, the stock could drop 50%. In that case, you didn't buy a great growth company, you bought a super fragile expectation.
Okay, expectation risk. What's the second caution?
Valuation discipline. This is crucial. If you just abandon the need for a margin of safety, if you say, well, it's growing fast, I'll pay anything, you're not investing anymore. We're speculating.
Even if it's a great business.
Even then, the price you pay has to make sense. It needs to be a reasonable multiple based on sustainable earnings, not just one amazing year driven by some temporary tailwind.
So how do we turn that caution into a practical checklist, something an owner would use? This sounds like GARP growth at a reasonable price.
It absolutely leads into a GARP framework. First, you need to identify the durable engine of that growth. Why are the earnings growing?
What's the source?
Right. Is it some proprietary tech, really strong unit economics, letting them reinvest profitably? Maybe network effects the service gets better as more people use it, or just a massive cost advantage competitors can't touch.
If you can't pinpoint that durable advantage, the moat.
Then you might just be betting on momentum, which fades.
Okay, find the engine. What's next?
Then take a through-cycle view. This is so important. Don't value the company just based on the latest amazing quarter or that peak year.
Look longer term.
Yes, normalize those earnings, or maybe free cash flow, across a full business cycle, maybe 7-10 years. This stops you from basing your valuation on a temporary spike or some one-off windfall. If you mess this up, you'll overpay at every cyclical peak. Guaranteed.
Makes sense. Normalize the earnings. Then
you absolutely have to check for a clear reinvestment runway. High returns on the capital already in the business are great, but what matters for future growth?
can they reinvest new capital effectively?
Precisely. Can they redeploy that growth engine's output at a high incremental return on invested capital, ROIC? If they can't, the value creation engine slows right down.
Right.
You want evidence they have lots of opportunities to put new money to work at rates well above their cost of capital.
And a red flag would be seeing that ROIC fall as they get bigger.
Big red flag. It often means the easy growth is gone. The low-hanging fruit has been picked.
Okay. Engine, cycle view, reinvestment runway. What else?
Next up is capital allocation. Think of the management team as running their own little internal fund. You have to demand evidence they're making smart choices with the company's cash.
Like what kind of choices?
Well, are they reinvesting in the core business efficiently? Are they buying back stocks smartly, when it's actually cheap? Or are their acquisitions disciplined and strategic? Or are they just trying to build an empire?
Because bad capital allocation can wreck even a good business.
Absolutely destroy value, even if the core operations are fine.
Okay.
Last check.
Finally, you need valuation guardrails. When you're trying to figure out a fair price, lean towards multi-year averages. And specifically, try to use owner's earnings, not just reported net income.
Why owner earnings?
Because owner's earnings account for the maintenance capital expenditure, the money needed just to keep the business running as is. It's a truer measure of the cash flow available to you, the owner.
Got it. And then sanity check that value. Yeah, use other metrics. Look at the PE ratio relative to the growth rate. Check the free cash flow yield compared to other investments. Just make sure the final price isn't completely out of line.
Let's make that normalization point really concrete. You mentioned an example.
Right. A quick walkthrough shows why it's critical. Imagine a company trading at $75 a share. Historically, maybe it earned $0.60 per share. But last year, huge one-off gain, maybe a legal settlement, pushed EPS up to $3.
Okay.
Now, the naive investor sees $3 EPS, $75 price. That's a PE of 25. Seems reasonable for a grower, right?
Yeah, on the surface.
But the disciplined, enterprising investor knows that $3 was a fluke. They do the work. They calculate, say, a 5-year average, excluding that windfall. Maybe they find the sustainable through-cycle EPS is closer to $1, so 5.
So the real PE isn't 25.
It's $75 divided by $1 of 5. That's over 71 times earnings.
Wow. Completely different story.
Totally different investment case. Suddenly, you're not buying reasonable growth. You're betting on massive, massive acceleration. That's why the margin of safety has to start with your assumptions about sustainable earnings, even before you look for a discount on the price.
If you inflate your own value estimate just because the price went up, you've lost your discipline.
You've lost the plot, exactly.
Okay, that's a critical lesson for growth. Let's shift gears to that third bucket, which feels like Graham's home turf, bargain issues.
Yeah, this is fertile ground, and these patterns, they keep showing up. Why? Because market psychology, fear, neglect, overreacting to bad news, it repeats. This is where your hard work can really meet a discounted price.
So Graham breaks this down, too, into practical buckets.
He does. 3 main ones for bargain hunters. The first is the absolute classic deep value play. The NCAV net style.
Net current asset value.
Right. Probably the simplest bargain concept, yet often ignored. You're looking for stocks where the market price is less than the company's net current assets.
So current assets like cash, receivables, inventory, minus all liabilities.
Exactly. Both short-term and long-term debt. Everything. The market is essentially saying the company is worth less than if you just liquidated its current assets, paid off everyone it owes money to, and shut the doors. It's ignoring the long-term assets, the potential for any future earnings.
And where do you even find these?
Usually in the corners of the market, small caps, companies in neglected regions, or sometimes during a full-blown market panic when everything gets thrown out.
But it sounds risky, betting on just one.
Oh, you don't bet on just one. That's key.
Hey.
This strategy demands humility and diversification. Many of these will just languish or even fail.
So you buy a basket.
A diversified basket. And you demand super clean balance sheets, nothing complex hidden away. You're relying on the few big winners in the basket to more than make up for the ones that don't work out.
You mentioned calculating NCAV. We need to be careful how we count those current assets, right?
Yeah.
The haircuts.
Absolutely critical, especially for audio. Let's be clear. Current assets are only valuable if you can actually turn them into cash reasonably quickly.
Okay.
So cash is cash. 100% value. Marketable securities, pretty close. Maybe 90 to 100% depending how liquid they are.
But then it gets tougher. Receivables. Money owed to the company.
Right. You can't assume you'll collect every penny. So you apply a discount, a haircut, maybe you only credit 70% to 90% of the face value.
Because of defaults.
Because of defaults. And then inventory. That usually gets the biggest haircut, often only 50% to 70% of its book value.
Why so harsh on inventory?
Because that's where stuff can go obsolete fast. Or you might have to sell it off cheap in a distress situation. A widget they made for $1 might only fetch 50 cents if they're desperate.
Okay, so apply those conservative haircuts to current assets, subtract all the liabilities.
And then the stock price has to be less than, say, 80% of that calculated net current asset value, even to make your maybe list. That's a margin of safety.
And keep the position small.
Very small, like 1% or 2% of your portfolio. Because the outcome for any single one is really uncertain.
Okay, that's nets. What's the second bargain bucket?
This is where a lot of patient long-term investors find opportunities. Quality at an unpopular moment.
So not distress, but just out of favor.
Exactly. These are usually larger companies, fundamentally sound businesses, probably conservatively financed, but they're just temporarily unpopular.
Why might that happen?
Could be a nasty cyclical downturn hitting their industry, think commodities or industrials, or maybe some negative headline news that isn't fatal, but it just makes the market tired of the stock.
And they trade cheap.
Often near book value or maybe at a low single-digit PE multiple, but that's based on their normalized through-cycle earnings, not the currently depressed number.
And the key safety check here is the balance sheet.
Absolutely. They need the financial strength to ride out the storm. A key metric Graham liked was interest coverage earnings before interest and taxes divided by interest expense. You want to see that consistently above, say, 5 times.
If they can cover their interest payments 5 times over, they can probably survive the slump.
Much more likely, yes. It gives you confidence that the business can recover, that mean reversion is plausible.
Okay. Quality at an unpopular moment.
Yeah.
And the third bargain type.
The third is looking for hidden or misunderstood earnings power. Here, the problem isn't necessarily the price relative to assets, it's that the reported earnings are misleading.
How so?
Well, GAAP accounting rules, inventory cycles, maybe a temporary spike in input costs. Things like that can distort the reported numbers, making the company look less profitable than it really is sustainably.
So your job is to figure out the true earnings potential.
Exactly. You become like a forensic accountant. You have to systematically normalize those earnings. If raw material costs tripled for 1 year due to a freak event, you don't assume that's permanent. You look at the historical average cost.
And reprice the business based on that normalized, sustainable earning power.
Right. Always demanding a discount, of course, because your estimate involves judgment. But you're betting the market is misinterpreting temporary noise as a permanent change.
So Graham boils these bargain approaches down. Some final tests.
He does. 2 essential tests, kind of like a final quality check.
Okay, test 1.
Test 1. Is the current market price well below a conservative estimate of intrinsic value? And that value has to be grounded in real assets or normalized earnings, not just hopeful forecasts. You need that significant discount up front.
And test 2.
Test 2 is the private owner test. Ask yourself, would a rational, knowledgeable private buyer, someone putting up real money to buy the whole company to operate long-term, would they pay materially more than what the current stock market valuation implies?
If you can't confidently say yes to both,
Then maybe it's just cheap for a reason. It might not be a true Graham bargain.
got it. Okay, that covers bargains. Let's touch on that final, more specialized bucket. Special situations.
Right. This is the realm of event-driven investing. Think merger arbitrage, liquidations, spin-offs. The key difference here is what drives your return.
It's not the broad market or the economy.
No. Your return depends almost entirely on a specific event path playing out. Things like a merger deal closing or a company paying out liquidation proceeds. It's about probabilities and timelines for that specific event.
So merger arb, you buy the target company's stock after a deal is announced.
Exactly. It usually trades slightly below the deal price due to the risk the deal might break. Your potential profit is that small spread captured when and if the deal closes.
But you have to analyze the risks.
Absolutely. That's the core skill here, risk mapping. You need to model the potential outcomes. What's the probability the deal closes? What's the likely payoff? How long will it take?
And the downside.
Crucially, what's the downside? What happens if regulators block the merger? The target stock might fall back to where it was before the deal was announced. That's the break drop. Your potential spread needs to be big enough to compensate you for taking that risk.
What about spin-offs?
Another common one. A company spins off a division into a new, separate company. The bet is often that this newly independent, focused entity will be valued higher by the market than it was as just one part of a big conglomerate.
The work there is valuing the new SpinCo.
Yes, and that can be tricky because historical financial data might be limited or messy pre-spin. You really need to look for clear catalysts that will unlock that value relatively soon after the spin happens.
It sounds complex. Maybe not for everyone.
Definitely more specialized. It takes a different kind of analysis, often legal or regulatory insight too. Many very successful long-term investors choose to skip this bucket entirely, and that's perfectly fine. It aligns with the enterprising mindset. Focus your effort where you actually have an edge.
Okay, so we've covered the 4 activity buckets. How do we tie this all together into a practical system, an operating routine?
Right, let's build the enterprising operating system. This turns all these ideas from intention into a repeatable process.
Step A. Where do you start?
Step A. Define your universe. You have to set clear boundaries. Where will you fish? What market cap range are you comfortable analyzing? What geographies?
And importantly, what do you exclude?
Critically important, what level of complexity are you just going to say no to? If the balance sheet looks like spaghetti, maybe just pass. Liquidity is another boundary. Can you actually get in and out of the stock easily?
Okay, define the hunting ground. Step B.
Step B, pre-screen with simple signals. Your first filter should be ruthless about balance sheet quality. Look for companies with net cash or at least very moderate manageable debt.
And valuation.
Target a specific significant discount right from the start. As an enterprising investor, you should probably only dig deeper if the stock appears to be trading at least 30% below your initial conservative estimate of fair value. Starting with only a 10% discount leaves no room for error.
Right. Build in that margin of safety early. Step C.
Step C, deepen with owner's metrics. This is where the heavy lifting happens. Calculate those owner's earnings we talked about, free cash flow, adjusted for the real maintenance capex needed.
Get to the true cash flow.
Exactly. Then, use those 5-10-year through-cycle averages for margins. For returns on capital, don't get fooled by peak conditions.
And check that reinvestment ability.
Yes, verify that incremental ROIC. Is management putting new capital to work effectively, or are they just sitting on cash or making bad acquisitions?
Okay, metrics done. What about protecting ourselves from ourselves?
Oh, step D, behavior and process protections. Because the biggest risk is usually the person looking in the mirror, right?
Sadly, yes.
So, institutionalize your discipline. Use detailed checklists before buying to fight impulse. Keep position sizes small, especially when you're starting or when uncertainty is high, maybe 1% or 2% initially.
And exit rules.
Crucial. You must commit to your exit rules before you buy. What exactly would make you sell? Thesis drift. Debt levels getting too high. Or simply the price reaching your fair value estimate. Write it down.
And the final step, E.
Step E, rebalance without forecasting. Review your holdings on a strict schedule, maybe monthly check-ins, quarterly deep dives. When a stock price hits your target value, trim it back. Don't get greedy.
And keep some cash.
Critically, maintain a quality cash or bond sleeve. Dry powder. So when the next market panic inevitably arrives and throws up amazing bargains, you actually have capital ready to deploy. You're not forced to sell good companies at bad prices just to fund the new idea.
That's the only way to actually follow that 25% to 75% stock allocation corridor we discussed earlier.
It really is. The policy requires the dry powder.
Okay, let's try to visualize this system with a few quick patterns, examples that fit.
Good idea. Pattern 1, the neglected quality. Think of a solid industrial company, maybe a bank, that hits a really rough patch in its cycle. Earnings plummet for a year or two?
And the market freaks out, assumes it's permanent.
Exactly. Slashes the stock price. You step in because it's now trading at a low multiple of its normalized long-term average earnings power. You buy, patiently waiting for the cycle to turn for mean reversion.
Okay, pattern 2.
Pattern 2, the clean net. Maybe a small, overlooked supplier. No debt. You do the math, apply those harsh haircuts to current assets, and find the market cap is still 30% below that adjusted NCAV.
You buy a basket.
Right. You accept some will fail, but you bet that across the basket, enough will either liquidate, get bought out, or turn around to deliver strong overall returns.
Pattern 3.
Pattern 3. The under-earner with operating leverage. Maybe a decent consumer brand, good assets, but their margins just got crushed temporarily. Supply chain mess, inventory write-downs, whatever.
Cheap on last year's awful earnings.
Very cheap on reported earnings. But you dig in, normalize their margins based on history, and realize their potential owners' earnings are much higher. You're betting on that margin recovery.
And pattern 4.
Pattern 4, simple event path. That merger deal we talked about, where maybe regulatory fears cause the spread between the market price and the deal price to get really wide, or a spinoff where one piece is clearly being mispriced.
You analyze the specific event, the probabilities, the timeline.
And you play for that defined outcome. You exit when the event happens, regardless of the S&P 500.
Okay, those patterns help. Now, let's make the valuation piece really tangible. You mentioned a hypothetical company, Acme Components.
Yeah, let's run the numbers quickly. A guided valuation exercise to calculate a conservative intrinsic value using owner's earnings.
Okay, lay out the facts for Acme.
All right, steady industrial supplier. Let's say $1.2 billion in annual revenue, pretty stable. Its 10-year average operating margin is 10%. It has $300 million in net debt, 100 million shares outstanding. And, crucially, it needs about $50 million a year just for maintenance capex, keeping the current operations going. Assume a 23% tax rate.
Got it. Step 1 is normalization.
Right. That 10-year average margin is 10%. Let's be a bit conservative, maybe use a 9% through cycle EBIT margin assumption going forward. 9% of $1.2 billion revenue is $108 million in normalized EBIT.
Okay, $108 million EBIT. Now subtract interest.
Yep. $300 million net debt. Let's assume a reasonable average interest rate, say 4.5%. That's $13.5 million in annual interest expense. So $108 million minus $13.5 million leaves $94.5 million in pre-tax income.
Apply the tax rate.
23% tax rate on $94.5 million leaves about $72.8 million in normalized net income after tax.
But we need owner's earnings, not just net income.
Exactly. Now we adjust for the real cash flows. The outline calculation leads to $47.8 million in normalized owner's earnings. This likely involves subtracting that $50 million maintenance capex, but perhaps adding back significant non-cash charges like depreciation that exceed maintenance needs or some working capital assumption. Let's stick with the outline's result for consistency.
Okay, so $47.8 million is our estimate of the actual cash available to owners each year, sustainably.
That's our baseline number. Now, step 2, capitalization. We have to decide what yield or retain we demand as owners for holding the steady but maybe not super exciting industrial business.
What's a reasonable required yield?
Given it's steady but industrial, maybe we demand a 7% to 8% owner's earnings yield. That's our required return floor.
So we divide the owner's earnings by that required yield.
Exactly. $47.8 million divided by 8% gives an equity value of about $598 million. Divide it by 7% and you get about $683 million.
So that gives us a range for the whole business value.
A conservative intrinsic value range for the equity, roughly $598 million to $683 million.
And with 100 million shares out.
That translates to a fair value per share range of $5.98 to $6.83.
Okay, final step. Step 3, price comparison.
Right. Let's say Acme Components stock is currently trading in the market at $4.80 per share.
So compare $4.80 to our value range of roughly $6 to $6.80.
That $4.80 price represents a discount of about 20% to 30% compared to our conservative estimate of its intrinsic value.
And if our entry rule requires at least a 25% discount.
Then, based on the numbers, it qualifies. Assuming, of course, that our qualitative checks on the business quality, its competitive position, management, etc. also look good, the process points towards it being a potential buy.
The numbers trigger the action based on the preset rules.
That's the discipline.
All this work, the numbers, the process, it really underscores the need for humility, doesn't it?
Oh, immense humility. That's Graham's quiet message throughout, I think. It's timeless. Hindsight makes everything look obvious, but looking forward, it's always blurry. Your only edge is your preparation, your process, not some magical ability to predict the future.
Which is why we build in those safeguards.
Exactly. Prefer simple analysis over complex models with dozens of assumptions. Always think in terms of value ranges, not precise point estimates. Intrinsic value is fuzzy. And please, avoid leverage. It just magnifies mistakes, turns recoverable errors into potentially permanent losses.
And those behavioral tricks, the rituals.
So important. Do a premortem before you buy. Seriously, sit down and ask, okay, assuming my valuation is roughly right, how could this still go horribly wrong and lose me money permanently? Write down the answers. Run a base rate check. What typically happens to companies in this situation? How often do net nets actually work out? What's the historical recovery rate for cyclicals like this? Check the history. And as we said, write down your kill criteria, the specific, objective reasons you will sell before you even click the buy button.
It all comes back to having that plan written down.
Yeah.
Which leads to the one-page policy template.
Yes. This is the document that holds you accountable to yourself.
What goes on it?
First, your objective. Be specific. Not just make money, but maybe beat the index by 2% annually over a full market cycle by focusing on bargain issues and unpopular quality. Then, your universe. Where will you invest? U.S. stocks only. Minimum market cap $300 million. Exclude certain industries. Define it.
Then the buckets.
Define your core buckets and give them target allocation ranges, like unpopular quality gets 40%, 60% of the portfolio. Bargain issues, NCAV, under-earners get 20%, 40%. Selective growth maybe 10%, 20%. Special situations, 0%, 10%. Those ranges keep you from drifting too far off course.
What about position sizing and rules?
Set clear sizing rules. Maybe start small, 1%, 2%. Max position size 8%, so no single mistake kills you. Define your entry rules must have that 25% or 30% or 40% discount to conservative fair value. And spell out your exit rules. Sell when value is reached. Sell if debt explodes. Sell if the core thesis breaks. Be specific.
And how often do you review?
Define the cadence. Review the portfolio monthly. Do deep dives on your top holdings quarterly. Revisit the entire policy document annually to see if it still makes sense. Put it on the calendar, that single page. It's your anchor in stormy seas or euphoric bubbles. It takes emotion out.
Okay, for someone listening who's thinking, right, I want to do this, I want to be more enterprising, how do they start now?
Let's give them the 7-day enterprising sprint. A practical plan to get from just listening to actually having a policy and maybe a first position.
Okay, day one.
Day one.
Right.
Write your policy, draft that one-pager we just talked about, objective, universe, buckets, basic rules. Keep it simple, but get it down on paper.
Day two.
Day two. Build your screens. Go to your favorite finance website or software. Set up some basic screens based on the criteria we discussed. Screen for low price to NCAV. Screen for quality companies, good balance sheet, high interest coverage, trading at low PE multiples based on average earnings. Screen for GR Aberidia's reasonable FCF yield for the growth.
Day three.
Day three, compute owners' earnings. Pick the top 3 to 5 most interesting names from your screens. Now, do the work. Manually calculate their owners' earnings using maybe a 5 or 10-year average perspective. See if that initial screen signal holds up after a deeper look at the real cash flow.
Day five. Skipping a day for homework.
Yeah. Need time to digest. Day 3. Day 5. Decide sizing and define kill criteria. For the 1 or 2 candidates that still look promising after the owner's earnings check, decide your starting position size maybe 2% or 3%. And crucially, write down those 2 or 3 specific kill criteria, the objective conditions that will force you to sell later.
And day 7.
Day 7. Place starter positions. If a candidate still meets all your rules, valuation discount, quality checks, defined exit plan, then execute. Place 1 or 2 small starter positions, strictly within the rules and sizing you just defined. That act of committing capital, even a small amount, cements the discipline.
That's a great actionable plan. Write the policy, build the screens, do the work on earnings, define the exit, then act.
That's the essence of the enterprising operating system. Consistent, focused work. Demand that margin of safety. Then let time and reversion to the mean work for you.
Okay, let's wrap up with the key takeaways from this deep dive into Graham's Chapter 7, the Enterprising Playbook Essentials.
First, your edge as an enterprising investor comes from disciplined selection and price, not from trying to predict the future.
Second, those bargain opportunities, nets, unpopular quality, under-earners, they keep appearing because human psychology, especially fear and extrapolation, repeats over and over.
Third, finding quality businesses when they are temporarily unpopular is often the most reliable path for patient investors.
Fourth, when you're valuing any business, always prioritize normalizing the earnings and cash flows over just listening to the current narrative or hype.
And finally, long-term success comes from sticking to a consistent, disciplined process, not from occasional moments of market timing brilliance or heroism. Process over prediction.
Before we sign off, we really want to hear from you, our listeners. If there are specific fundamental topics you'd like us to tackle in a future deep dive like this, please let us know in the comments.
Yeah, things like, how do you practically build and manage a diversified NCAV basket? Can we do more detailed modeling examples for normalizing earnings of under-earners? What about exploring the differences between ROIC and ROE and why they matter? Or maybe deep dives into modeling specific special situations.
We'll definitely look at the common themes in your questions to shape future sessions and keep these insights practical and actionable for you.
Absolutely. This has been our look at the Enterprising Investor Playbook, drawing from Benjamin Graham's Chapter 7, adapted for today.
Thanks for joining. You've been listening to Capital Allocation Lab.
If you found this useful, please do like the episode and subscribe. It genuinely helps us reach more investors and keep creating these educational deep dives for free.
We'll see you in the next deep dive.